How's it going, guys? Welcome to the sweep. We're going to get started here in just a second. As you guys get logged in, feel free to ask questions, say hello, chat, let me know you're out there. All right, let's see here. Just making sure I'm using a new system, so I want to make sure that everything is running the way it's supposed to. Give me 1 second, guys. Okay, that's going. Good. All right, audio's coming in for me. Okay. 1 more second. Okay, I'm going to skip that then. All right, so I was trying to go live on 2 different platforms with this new software that I've got, but I don't think I set up the other one correctly. So we're going to skip that one for today. As long as we're live on Facebook, that's where we usually are, so we're going to keep at it with that and just that platform today. Okay. So where I'm trying to run is on Rumble. So I'm wanting to build up other some of my other platforms. So I was going to run live on Rumble with this session, but I wasn't able to do it. So we'll skip that for now. Okay. So what we are going to talk about today is normally like we normally do. We're going to talk about the Forex news. So let's go ahead and cover that really quickly, and then we're going to get into a pattern. So we're going to go to forexfactory.com, and we're going to look at Saturday, which we only have daylight savings time shift for Australia, and on Sunday, a bank holiday for Australia, and then a monetary-based year-end for Japanese yen, and then MI inflation gauge for Aussie, and bank holiday for the CNY. Okay, so not much there. Let's look at Monday. We do have OPEC meeting all day, so keep an eye out for that. And that's and you can see that it's going to affect a lot of currency pairs, right? Not just one currency pair, but it's going to affect all, right? So that's why it doesn't have a specific currency associated with it. Right here under currency, it just says all, so all currencies, right? So keep an eye out for those OPEC meetings. And then RBA rate statement for the Aussie at 9:30 p.m. Mountain, so it's 11:30 p.m. Eastern for those of you guys that trade later on. And Tuesday, pretty light morning, 8 a.m. Mountain, ISM Service PMI. So that's coming out. And then we've got Lagarde speaks for the Euro, ECB president. And we've got Quarles speaking for FOMC, Federal Market Committee for the U.S. dollar. And then we've got RBNZ rate statement for New Zealand dollar, 7 p.m. Mountain, 9 p.m. Eastern. So this could kick up some dust here at 8 a.m. And then again from 9 to 11, and then again in the evening. So you might want to be careful trading on these days, just so that you don't get caught off guard, especially with the OPEC meetings, and then some of these spread out through the morning, early afternoon, and then into the evening. So there's not a lot of them, but just don't get caught off guard with them. Wednesday, we've got ADP non-farm employment change, 6:15 a.m. Mountain Standard, 8:15 Eastern. Again, keep in mind, guys, we're not trading during these times. We're staying out of the market during these times, right? So I always want to emphasize that in case you're not certain. We don't trade announcements, and I'll show you guys here in a moment why. And I've showed you guys in the past, but there's a blatant example here again. The CAD on Thursday, that's BOC, so Bank of Canada, government Macklem speaks. So keep an eye out for that one at 10 a.m. Mountain, and that's afternoon Eastern. And everything else still looks pretty light. We do have unemployment claims and IVPMI. Keep it out for some of these because the impact could also increase as it gets closer to the day. And then Friday, we've got a ton for the CAD and U.S. dollar at 6:30 a.m. Mountain, 8:30 a.m. Eastern. Employment change, unemployment rate for the CAD, and then average hourly earnings for the U.S. dollar, non-farm employment change for the U.S. dollar, and unemployment rate. So keep an eye out for those on Friday, October 8th. That brings us into Saturday, which there's nothing, so we're not going to worry about that. Okay, so check this out. So we had, I'm going to bring this back up really quickly. So we had, let's go back to this week, right? And let's look at, so Fed Chair Powell testified. Okay, so we had that, and if you watch that, you'll kind of see what those are all about. But they always do those, right? They always have the Fed chairs testifying. And then Powell spoke there. I'm looking for a specific one. Testifies. Was it Monday? When was it? Oh, man. Oh, you know what? It was not on Forex Factory. So they were talking about the possibility of raising debt ceiling, right? You guys have heard about this. It's like $3.5 trillion or something, right? They want to borrow, and now they're kind of holding things up with infrastructure bills unless, the other side of the aisle agrees to pass this, $3.5 trillion bill. So if that were to pass, then that would decrease the value of the dollar and increase the value of gold, right? And if you guys have been watching gold, we kind of had this almost a bottom out point right here, and then it popped up. That was really nice. Took some of that. So 379.6 pips. This is XAU USD, so this is dollar versus gold, gold versus dollar. But a lot of what we're hearing in the news hasn't been positive for the U.S. dollar. Nonetheless, all we've seen over this whole week is the dollar strengthening. 2, 3, 4, 5 days right there, just there, of the dollar strengthening, right? We had FOMC announce that they were not going to increase interest rates recently, and nonetheless, all we've seen is the dollar strengthen more and more and more, right? Which is counter to what it should be doing technically, right? So we can see from about here, right, which is May 25th to where we are currently, we've seen, or maybe May 24th, right? We've seen 686 in the euro US dollar. If we look back for this price right here, we can see that we haven't even been at this price since we passed through it right about there. And this is July, right? July 2020. So over a year ago since we've seen these prices. We got close here, right? And this is like the end of 2020. So this is November. We got pretty close there, and even there in September. So September, November got pretty close to that line where we currently are. And the last time we saw it was back here over a year ago, July 2020. So you can see that the U.S. dollar is strengthened in spite of the fact that it should be weakening. So all the announcements that have come out have not necessarily been in favor, the ones that matter have not necessarily been in favor of a strengthening U.S. dollar. Nonetheless, that's what we've been doing. And this is consistent not just in the euro-U.S. dollar. If you look at any USD paired currency, right? So GBP USD, we saw a lot of selling going on, right? If we look at the USD Swiss franc, we saw a lot of sell. These are all 1 hour charts, but you can see a lot of selling going on. And it's across the board, right? So again, that's why we don't focus on trade on announcements, anything like that, because it's bogus. They're just going to do whatever it is that they're going to do, and they're not going to be concerned about what the announcement is. Where traders are concerned about what the announcement is, and they try to trade based on the announcement, a lot of times they're going to lose their shirts. Okay, so let's move on from that. I want to show you guys the setup, and for those of you guys that have been around for a little bit, you guys are already familiar with these, but I did have some subscribers, recent subscribers that, you know, were asking questions about them, so I wanted to revisit them for those of you guys that have not seen these setups, and then also for those subscribers that wanted some clarification on some of these. So the two patterns that I want to talk about today are going to be the hiccup and head fake. And the reason why we talk about them together is, for one, when we first started with these patterns, these were kind of our first patterns. And so, and they both kind of occurred for us at the same time. And they came as a result of individuals that were looking into the indicators a little more aggressively and not really figuring out that there are these small nuances that dictate whether the trade is, or whether the indicators are indicating buy or sell, or whether it even looks like they're indicating anything at all. And one of them, the head fake, is actually really elusive in that regard because of the way the major and minor look. So let's go over these, and we'll talk a little bit about positioning, because generally that comes up when we talk about these setups as well. So I'm going to bring up a 5-minute chart here. Okay, so let's talk about the hiccup first. The hiccup, so when we say hiccup, we're just, well, the hiccup pattern, but when we say hiccup, what we're referring to is when the lines within an individual pair disagree. So here we can see that the minors, the gray and black lines, are disagreeing. Okay, the black line is down, okay, and the gray line is up, and they're not crossed or touching. Okay, so that's a hiccup. The green and red lines do this as well, right? If the green was up and the red was down, then we would have a hiccup there as well. And then in reverse, it would be red up, green down, or black up and gray down, right? So this is what we call a hiccup. Now, the hiccup pattern has 3 other elements, okay, 3 other indications that you want to consider, parameters, okay? So one is the hiccup occurring, so the hiccup right here, occurring oversold below this red line, or overbought. If it's overbought, it's going to be in reverse, right? So if you flip that, then green would be down, red would be up. instead of green up, red down, right? Not crossed or touching. Okay. So here in this example, it's happening oversold below this thick red line. At the same time, on the same candle, we have miners that are crossed and trying to go up and touching the threshold at least. So touching that red, thick red line or beyond. Okay, that's the second parameter. The third parameter is in pressure. We want, when these are oversold like this, we want the green line to be below the red line. Doesn't matter if they're pointed down, doesn't matter if they're pointed up. We just want the green line to reside below the red line. And right there it is below the red line, right? And then the fourth element is the candle itself. We want to see a green candle when these are oversold and green is on bottom of red. Okay, we want to see a green candle. And this gives us our hiccup pattern. And this trade is a sell trade. Okay, so when we send out alerts for this particular trade, it would be to sell in that scenario. Okay, so if we go to advanced, you can see we get these, right? Hiccup, 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 so on and so forth, right? Okay, so right here, when we evaluate this one, this is a sell that we're evaluating, which looks counterintuitive, right? Because if anything, we can see that these are starting to bend up a little bit more than they are down. And we've got a green candle. So showing, okay, there's some up movement there, right? But basically what's happening is we're not actually getting majors to agree to the buy side. And we've talked about the zero-sum market, zero-sum game, and if you guys aren't familiar with what that is, you can even Google it and find out what a zero-sum game or zero-net game or zero-net market is. Basically what it means is in order to buy, somebody has to be selling. In order to sell, somebody has to be buying. Well, there's always traders doing both, right? Buying and selling. But the majority of traders, miners in this situation, are attempting to buy. And the majority of major impact in this situation are neither buying nor selling. They're just releasing trades. Right? For those of you guys that have watched the videos, Day Trading for Beginners, we always use the example of a scale, right? To explain the zero-sum game, the zero-net market. So what's happening is if we have buy on this side of the scale, okay, I'm not a good drawer, but this is buy, that's a pan, right, where you would put weight. You put more weight there than there is here, then that would favor that direction. In this case, not necessarily down, but the buy direction. If I had more weight here than I did here, then that would favor the sell direction. Okay? So what's happening is we're oversold, right? Which means this pan right here is all the way down here, and there's not much, if anything, left to go. There's too many sellers and not enough buyers. So when you have too many sellers and not enough buyers, then, and you want to continue to sell, then you have to get traders to buy or do the opposite so that you can continue to sell, right? So right here, they're oversold there and there. So right there, they gave some back, right? Because they were oversold, so they gave some back. Now what happens is the miners begin to buy, right? So they put their weight there. And the majors, so that buying has a reaction in the market, will just release trades. We'll take trades off of that pan, right? And just pull them out of the market. Okay, release lots. So that means that this pan is now lighter, and this pan is now a little heavier, and then you get your green candle, right? And now they've officially sold the bear trap or the bull trap, right? Miners are starting to buy, so they have put trades in on the buy side. And majors versus buying to get the market to come off of the oversold or get that zero sum to work have just released trades so that the market reacts, right? Because now this pan is lighter and this pan is heavier, so the market buys. And when that happens, then miners will continue to sell, load up here, right? So as they do that, majors want to make sure that they've got that counterbalance, right? That counterweight. So as the market moves against them, that gives them an opportunity to continue to sell. Okay, so right here, they would sell. They would short the market. And then it sells. Now, if you watch this trade, if you replayed this trade right here, this candle right here, as it got down to here on that shadow, as the market moved that far down, you would see that the major and minor were both pointed down. Now, if you're using this as a pattern and not discretionarily looking at the indicators, then you want to wait for the end of the candle to take your next trade, because this is a 3-trade setup. The next 2 trades that I'm going to show you, the next 2 patterns I'm going to show you, have 2 follow-up trades. So there's 3 trades total that you could potentially take with this setup. Okay. So the first one is sell, and that moved 16.4 pips. It's very little drawdown, like 1.5 pips of drawdown. Okay. Now, if these lines continue to point down when the candle ends, this is an indication to buy. Again, it's illogical, right? It doesn't make sense at first glance because these lines are pointed down. So how is it that those lines pointing down is the indicators telling us to buy or get ready to buy? Well, it's simple. The indicators are telling us that the market is now vastly oversold because initially we were oversold, and then the majors took trades out of that pan, and the minors. Oh, sorry, wrong way. So yes, the majors took trades out of that pan, and the minors added trades to this pan. So then it started to go to the buy side. Okay. Then the majors took their trades once it hit a certain level and put them back onto this pan, while the minors were adding to this buy pan, right? So then the weight shifted, the market shorted, and all those traders that were in on that buy got stopped out, right? So they hit their stop loss, which means all those trades that were in there, they are now off that pan and in the pockets of the majors, because the majors would have won those trades, right? For all those people that are stop lost. Okay, so now there's less weight here and more weight here. So this now is vastly oversold. Okay, and we know that 60 to 65% of the time, if both of these lines are pointed down, that there's still likelihood on the next candle that we will see some down movement a little bit and then up movement. So the call right there is nothing if you're looking at the pattern, but if both of those lines had stayed down, then that would be our entry for a long trade, a buy trade. Okay, so we're not going to look at that one just because it didn't do that on that one. Those didn't stay down. So I'm going to show you the next example. Okay. Yes, we did pop to the long side, but it actually started right here. I'm just going to replay this just to show you guys. Okay, so right there. Okay, so watch as that shadow occurs. Watch as the market moves short. And what happens to the major minor lines is green, red, gray, black lines right here. So as that goes down, those lines point down. See that? Majors down, minors are pointed down. So if it stayed that way, then after that candle was done, we would take a buy trade. But it actually made the move early. It didn't wait until the candle was done in that example. It made the move early. So look at that. They point down, and then they popped back up. So at that level, they were pointed down, and they moved back up, you know, all the way to 16.4 pips, all the way to the beginning of that candle, right? Then after that, they went up on the next candle, and so on, okay? So let's get to our next example. All right, so right here is our next example. We can see that the majors are above the blue line, that thick blue line right there, right? And they're hiccuped. Green is down, red is up, okay? And the minors are again crossed and pointed down, touching the threshold. Green is now on top. We're back here, we wanted it on bottom. And we have a red candle. We're back here, we wanted a green candle. Right? So it's just the few things that are in reverse, right? Okay. So right here, this would be a buy indication. And the reason why this is so genius is because it really illustrates how the miners trade, right? And we're watching it happen. We can almost see their thought process, what they're using to analyze the market and how they're making their decision as to whether to buy or sell. Okay, so if we stretch this out, we can see that we have a downtrend right here. Okay, so if I channel this right there and right there, so we'll disregard these outliers right here because that channel fits a lot better. So you can see over 90% of the market movement is within that channel. Okay, so right there, and then add some support and resistance, which we don't use any of this stuff, right? We don't trade using any of this stuff, but I just want to show you guys what the rest of the market would be using in this scenario in order to justify their trade. Actually, let's put that right there. Yeah, that's good because that picks up this and this. Okay. So right here, and for those of you guys that don't know what some of this stuff is, I'll explain it just briefly. I'm not going to take too much time because I mean, you can trade with it if you'd like. Go look up videos. You can find videos on this garbage, you know, aplenty, and you know, on YouTube or whatever, but it's garbage. And when you backtest it, and you guys have videos on backtesting now because I let out the golden ratio analysis on one of the sessions of the sweep. So look for that if you guys are not sure how to properly backtest. So one thing we see here is that we have a trend, and when you're at the top of a trend, right, then you start to trade the opposite direction, expecting that it's going to bounce at the top like it did here, right? It goes to the top of the trend, and then it bounces off, and then it goes to the bottom, and then it bounces off, and then out to the 50% line, and then bottom and bounced off again all the way back to the top of the trend, bounced off to about the 50% line, came back, and hit the top of the trend again. So what you're expecting at this point, which is why we don't really use trend, is you expect that it's going to sell for that one reason, right? Trend, it's at the top of the trend. The second reason is that you hit resistance, the level of resistance, and you pulled back, right? So that left a candlestick pattern, like a hammer, right? It's called a hammer or shooting star or whatever. So right now you have trend telling you to sell, okay, and that may not be enough for some people. Resistance, okay, and candlestick pattern, we'll just call it CP, candlestick pattern, okay, So you've got these three things going for you. Now, a lot of times when you've got some of these things going for you, you're waiting for your entry. When do you actually enter the trade? The most popular reversal for traders around the world, not us, but traders around the world, is an H1 reversal by way of price action. So a 60-minute H1 out 1 hour, right? 8-hour 1 H1 reversal price action. And price action is when you have a high that is lower, in this case, a high that is lower than the previous high, and a low that is lower than the previous low. So lower high, lower low. That is H1 reversal to sell. Okay, so H1 reversal price action. I'm just going to put PA. So you got 4 things right here that would be telling a trader to sell, right? And the one thing I want you guys to realize, if nothing else, even if you didn't learn this pattern, is just that who do you think, and you guys have heard me talk about this, but every time it comes up, I'm going to talk about it. Who do you think invented trend and resistance and candlestick patterns and H1 reversals and price action? Was it a trader that just realized that and started using it? No, it wasn't a trader. It was the majors, the institutions that taught traders how to use these things. Why? Well, because then they would know when these things happen what traders are going to do. Even if not all traders do it, enough of them will do it that it gives the majors the ability to do the opposite. Because if they're going to attack you, they need to know when to attack you. See, no one can see exactly how many trades are in the buy position or sell position, how many lot sizes are in either direction. No one can see that. Not the institutions, no one. No one can see that. So if they can't see that, then they need to know, okay, where am I certain that the miners are going to do something and I can do the opposite? Enough of them that I can do the opposite. Well, if they taught you where to execute, then they know exactly where you're going to do it. So how did they create that? Well, as it got to the top of the range, right there, you can see they already started to pull back. See the kink in the majors? Miners already started to pull the other direction as well. They're more releasing trades right there, right? Miners are kind of hiccuping. So they're not buying or selling, they're just releasing. Maybe they took their take profit or whatever because it's the top of the trend, right? They're not going to try to trade beyond the top of the trend because that's their guidelines, right? Okay. So then the miners begin to sell. And the majors, just like before, began to release trades so that would give more movement to the candle to create that price action, knowing that once the miners got that price action, then they would begin to sell even more aggressively. Okay? So right here, miners are committed to the sell. And that's what gives us this hiccup pattern. Okay? So we can actually see that being played out in the market. We can see the majors taking advantage in this situation of the miners, and we know exactly which direction to trade, right? Okay, so right here we take a long or a buy trade, right? There's our buy trade. Now we know, now check this out, they're both crossed and pointed up. Before we wanted them crossed and pointed down. They did, but they didn't stay that way. Here they crossed and pointed, or they started to point up. So now they're vastly overbought, right? Because they're pointed up after the fake out, we call this a fake out pattern, the hiccup pattern, the head fake pattern, the gray dagger, which we've covered in another session, other patterns that are fake out patterns. When they occur this way and then give you that double confirmation to both start pointing up after the fake out, then you know that the market is now vastly overbought. In addition to that, we can also see that a lot of those miners hit their stop loss. And the reason why, there's a number of reasons why we know that, but the most prevalent, just looking at the indicators, is this. notice that the miners had just crossed on that candle. They had just decided to sell on that candle. So when that happens, and then on the very next candle, when it abruptly changes and they cross the opposite direction, that's not because they did that on purpose. That's not because they said, oops, just kidding, we're not going to sell, we're going to buy instead, right? It's because they hit their stop loss. Now, when the majors do that, they cross down and then abruptly cross back up. That's on purpose when the majors do it. When the miners do it, they didn't have a choice in the matter. So when it's one candle right after the other, the miners hit their stop loss. A lot of them, enough of them that they now crossed and those lines crossed and point up. Okay? So right there we know, okay, if miners don't have that counterweight going to the sell side anymore and majors are buying, then we're vastly overbought now. There's not enough room to continue to buy. So there has to be room that's created. And that means that you're likely to get a sell candle, right? A candle to the short side right here. Okay? Now, we know, again, 60 to 65% of the time that we're still going to get a little bit of buy right here. And so what we do is we look for positioning. Now, when we look for positioning, and sometimes you can just take the trade, just depending on what you've back tested. But for those of you guys that know how to position using a smaller time frame, like a 5-minute, then that's what you would do. You would look to see when the correct time to enter would be. And the two most common positioning patterns for the 5-minute is that same double confirmation where you have both major and minor overbought for more than one candle, so at least 2 candles or more, and they simultaneously cross and point up together. All right, or they're both pointed up at the same time. Okay? That would be one place to enter and get into a sell if we're using it for positioning. So we're saying we're looking for where the 5-minute is going to max out, and then we're going to take it the opposite direction. Okay. The other is major and minor being overbought for more than one candle, so at least 2 candles or more, and then majors persisting up and minors fatiguing, either hiccuping or maybe even soft crossing down, kind of like they're doing right there, right? Where they'll go, minors will go like this, right? So like they'll create a hiccup or even a little soft cross, okay? So that would be our entry for a sell as well. So let's go forward and see where that occurs. Okay, so these are at the exact same time. This is the last 5 minutes of this 60-minute chart. You see the price is the same, 106.371, 106.371. So we're going to go forward on a 5-minute chart. Put this over this. Now we're looking for an entry to sell, okay? So that sold, just not very much, 3.1 pips. Okay. All right, so see how they're both crossed and pointed up? But again, what was the other parameter that we were looking for? That they were already overbought for at least for more than one candle, so at least 2 candles or more. And if we go back 1 candle, they were not both overbought, right? Miners are in the channel now, gray and black. Now they're almost overbought. Okay, now they're overbought, but that's the first candle that they're overbought, right? So that'd have to be the second candle or beyond, and then them be pointed up to be able to use that. So we're not going to use that. Okay, that one sold as well. But from there, it's only about 5.1 pips, so still not very much. I mean, it's okay depending on what how many pips you were taking it for. Okay, so we would not have sold there either. We're still waiting for our entry. Okay, again, they're overbought, right? But again, they just arrived overbought. See, they were not overbought here, so they're just overbought here. If that was the second candle that they were overbought, then we would have entered our sell right there. Okay, so majors, we can see, have some persistence. Minors are more fatiguing. This is almost like a double, like a hydra, but in this case, majors are still pointed up, where minors are now starting to fatigue and gas out. So that would be a better entry, 106.479. and we'd be looking to sell to go to the short side. All right, so let's mark 106,479 on this chart. 106,479. 479. Okay. So right there, if I blow that up, let me just do this. Almost the very top of the move right there. So about 1.8 pips away from the very top. And I think this is the same. Yeah, 1.7, 1.8 pips. Okay. So right there we would have been at the very top as the move started to pull back. So what would that look like? Let's look at that. I'm going to replay both of these charts. Actually, if I replay both of them, I'm going to have to replay every chart in this chart book. All right, let's go for it. All right. If audio starts to cut out, it's because I'm using a lot of resources to run this replay. So just stick with Okay. So let's see when that happened and when we would execute that trade. So let's go 50 times the speed. So let's go 100. So not there on the 5-minute, right? Not there. We're going 100 times the speed on the 5-minute. So, okay, not there. Not there. Oh, getting close. So let's slow that down. Two minutes and 30 seconds. Okay, right there we get up to that height that we saw there, right? 1 minute and 30 seconds. 5, 4, 3, 2, 16 seconds. So let me slow that down. Okay, right here we've got about 16 seconds left. We've got what we're looking for. So then we would enter our trade. 3, 2, 1, boom. That's where we'd enter the trade. And then go back down, right? Because the indication right here was get ready to sell. Even though they're pointed up, it's telling us get ready to sell. Right here, we waited for positioning, and then we entered our sell trade. Let's fast forward. That's 7 right there. 10.4, and then some. 13.6. Okay. Now, after that sell trade, okay, this is a minute and 45 seconds, so let's go back to that. Okay. Oops. After that sell trade, if both of these lines are pointed down, then we sell again. Okay, so let me run this down for you again. Right here, we buy. Right here, because they're pointed up, we wait for our positioning, and then we sell. And then right here, if both of these lines are pointed down at the end of that candle, we sell again. Okay, that's the only logical, at first glance, logical setup, because they're both pointing in the same direction. Now right here, they're not pointing in the same direction, and I don't think they end pointed in the same direction either, but let's just go to the end of it. 5, 4, 3, 2, 1, 7 seconds. So right there, we can see that they're not both pointed down. But on the next candle, just wait for that, 3, 2, 1, right there, now they're both pointed down, so right there we would take our next sell, which is also ironically it looks like dirty pressure. Green on bottom, all 4 lines pointed down. So that's more verification, validation that we'd be taking a sell. Which, by the way, if you guys have watched the videos on dirty pressure, that's also one that we sent out alerts for, notifications for, right? So you would actually get this notification. You would have gotten this notification right about, so let's just get down to the last couple seconds. Right, 3 minutes. So at about the 5-minute mark, we're at 3 minutes now, you would have gotten the alert 5 minutes prior to the top of the hour, and then you would have executed that trade 4, 3, 2, 1 in 5 seconds right here for another short. 2, 1, boom, right there, and then take another sell. So it went up a little bit and then started to come down. There you go. It's another 10 right there. 10.4. And it kind of rides that line and then does whatever it's going to do. But that's the end of the sequence right there. Okay, so let's look at another one. Fast forward that so I can get more candles to show up. Okay, so let's go over that again. Right here, hiccup pattern, buy, double confirmation, get ready to sell. So we positioned and then we sold. That did not point down. Both of those lines did not point down. This is, however, by the way, a bootleg, which is another pattern that we actually went through on the sweep as well. So right there, that is a sell signal. So if you were familiar with that pattern and you back tested it, then you would take that one as well. And then right here, now that the lines are pointed down, you take another sell. And if it weren't for the follow-up, but for the dirty pressure, either way, you would still take a sell trade right there as well. Boom, and there's your next sell. Okay. Now, right here is a head fake. And the head fake has the similar parameters except for the majors. And it matters what order they come in. So when identifying this, you want to see, for one, that the minors have crossed and entered. So they're oversold on the previous candles. Minors have crossed and entered the channel or beyond, right? They're above this threshold or higher. And then the majors are also crossed and pointed up, but they're soft crossed and they're hanging back, right? They're still pretty low in the oversold. There's usually separation right here between major and minor. And green, just like with hiccup pattern, green is on bottom in this case when we're oversold. And just like hiccup pattern, we have a green candle when we're oversold. In reverse, it would just be like if you flip this whole thing upside down. It would look, that's how we would expect it to look. And I'll see if we can find an example of that. Okay, so right here, we would sell. Again, it looks illogical, right? It doesn't look logical when you're first looking at it because these are pointed up. We have a green candle, right? But this is a sell signal. This is the indicators telling us that you're better off to short in this situation than to go long. So right here we would sell. So I'm going to mark this after this candle. So right where that candle ended, we would sell. There's a big old sell. 2.6 pips drawdown, and then it went 15.6 pips. Okay, and check it out. Now we have our follow-up. Same as with the hiccup pattern. Both lines are pointed down after the fake out, right? So right there, because they're vastly oversold, there's not much room to go down anymore. We're saying let's look at a 5-minute and take a buy or a long trade at the correct place, right? If there is any positioning. Which, by the way, on a 5-minute, we can see that at the same time, these are already both pointed down, right? So we could still get some drawdown because we know 60 to 65% of the time we're still going to get drawdown. But right here on the 5-minute, we already look like we're positioning. We're doing the thing that we were looking to do, right? Almost. Minors are kind of out of the channel, so we want them to be oversold for at least 2 candles, right? But close enough, right? So right there, we would enter our buy trade from right there. These lines pointed down after the fake out are telling us you should get ready to buy. Looked at the 5 minute, it looks like it's already positioned, so let's go ahead and buy. And it does draw down. It goes down 10.5 pips and then up 6.6. And then these now are crossed and pointed up. So then we take another buy, right? And there's our next buy. That one moved up 21.4. So again, head fake, we sell. Double confirmation down, vastly oversold, so now we're going to buy. Both crossed and pointed up after that first follow-up. So here's the second follow-up, another buy. Boom. Okay, let's look at a couple more examples here. Okay, so right here, minors are crossed, and they had already crossed in the previous candle. They're in the channel. Majors are soft crossed. There's that separation between major and minor. Okay, we've got green on bottom. We've got a green candle, so this is a sell. I know at first it might look a little confusing, which is why we created this pattern, is because our traders were getting confused as to why they wouldn't be buying right here. We had to explain to them that small nuance. Majors are letting minors run away with things for a moment so they can have that counterbalance so they can pull the trade in the other direction. So right here we would short, we would sell, right? So there's our sell, 38.8 pips and about 1.1 pips of drawdown, so not much. And then here's the follow-up again. Look at this. These are pointed down after the fake out, which is telling us now it's time to look for a buy, a long opportunity, right? We're not going to wait for 5 minute positioning because we're running out of time here. But for the most part, I mean, we'd be good to go. It pivoted in the channel. I won't explain. Anyway, we're looking for a buy. 5 minute actually looks good. Okay. So right there, we would take a, so let's go back here. This one would be a sell from that position. This would be a buy from that position. And then they're crossed and pointed up. So we take another buy. So it's 3 trades, right? From that position. In addition to that, we also have dirty pressure on this one as well. Green on top, all 4 lines pointed up, and green just crossed on top. So right there, we would take another buy trade from this position. Boom. So that one went up 21.3. So we sold. Oops, wrong place. And that one went 38.3. Then we bought, and that one went 39.8. And then we bought again, and that one went 21.3. And very little to no drawdown. Okay. And then we create a hiccup pattern. Here we go. Green down, red up. Minors crossed and actually entering the threshold here. Green is on top, and red candle. So that's everything we're looking for the hiccup pattern. So right here, we would take our buy, our long trade. Boom. 7.6, so not much, 4.8 draw. Obviously the market is cooling off at this point. Now these lines are not pointed up together, so we're not going to sell yet. Still not pointed up together, so we're not going to take our sell yet. Major are pointed down, minors are pointed up. They're not bootlegged, but they're close to a bootleg. Nonetheless, we're not going to take a sell. Majors are up, minors are down. Still not going to take a sell, but now they're overbought, right, together. Okay, right there, now they're both pointed up. That's where we would take our short, our sell trade, right there. And there's our sell, right? So you can see it's using the same logic that we talked about before. It's just a matter of being able to read some of those small nuances to determine what to do in a situation that could otherwise look like a different situation, right? Like, why would we buy in this situation when these lines are pointed up, right? But then sell in this situation when these lines are pointed up. It's that small nuance, the separation, the pressure, the candlestick, all those things are telling us, yeah, this is bait for the majors to take advantage of the minors because of all the things that are happening there. That's what's so great about these indicators is that they're predictive, right? And when you learn how to read them, you can see these small nuances, and knowing what we know about the market, put it all together and formulate a trade plan that is titanium. It's Teflon, right? It's just, it's solid, right? So understanding some of these nuances creates this whole new breakthrough in your ability to trade successfully long term, and also be able to trade at any time, right? When you can really read the indicators, then you're not waiting for a setup like we've been looking at. You're not waiting for a pattern. You just know how to read them like you would read a book, right? You understand what they're saying all the time. And then it's just a matter of saying, okay, I can see that they're saying it's going to buy, but at this time of day, is it going to be enough to get a significant buy, without any significant drawdown, right? Things like that. So then you start to figure out an even more advanced way of determining as to whether or not you're going to execute on a trade based on some of these small nuances and then other information that you know of the market in general, right? So it does create a very dynamic approach to day trading. But if you never get to that place or have no want to ever get to that place with the indicators, you can still just take the patterns that still use those same nuances, but in a more structured format by way of systematic trading, square peg, square hole scenario, right? Are all these patterns present? Yes. Okay, have I back tested for this? Yes. Okay, awesome. Execute, right? What's my stop loss and take profit? What's my risk percentage? All right, and then execute the trade. Right? Okay. So for those of you guys that have not jumped on the bandwagon yet, and for those of you guys that have, awesome, congratulations. You guys can see that we don't just talk a big game, but we come through. And for the rest of you guys, check it out. Right? Here's the offer, as always. Right now, we are doing it for $10. $10 will donate 100% to charity. Of your $10. So we're not even worried about the money that you're going to pay to this. We just want you to have some skin in the game. But it also gives us an opportunity to take that and just give it to a charitable cause, in this case, Feeding America. So really cool organization, and that's where that money is going. Right? With this Trader Lite, you're getting the indicators that we're just looking at, right? You're getting the alerts and tutorials on how to use the alerts and how to understand the patterns. Live trading webinars, live coaching webinars, on-demand trading video library, just the starter, right, the beginner stuff. We don't want to, feed you by way of fire hose. Trader chat for mobile and desktop, and we actually just launched our new trader community. Check this out, guys. This is fire. This is awesome. Okay, this is a trader community. Okay, look at this. These are coaches. So we have coaches that are posting in there. We have students posting in there. But look what happens. I'm just going to show you today. Okay, check this out. So Jared is just showing kind of the trades. He's a coach, all the trades he took. Possible buy. So he's shouting out a trade. Possible buy on the euro, and then possible result. And then somebody who's just a member says, I just won that one. Thanks, Jared. What did that member have to do to get that trade? Nothing, just show up, right? Jared's like, hey, this is what I've done in this trade. And if you've listened to Jared, for the times that he trades, he's back tested so he can tell you stop loss and take profit, right? And so people that are taking these, they know what his stop loss and take profit are. A lot of times he'll just have them marked up on these charts, right? What his, where he's looking to go, what his stop loss will be, right? So then somebody's like, okay, great. I know that you back tested that, so I'm going to take that trade. And then, boom, he took that trade and he won it, right? So another coach just shouting out another trade, right? So here's another member just, some encouragement, right? Kept my rules and executed 100% this morning. Took this buy on the Euro USD at 601 Mountain, right? So he took a trade, it won. You can see it was a nice stretch, and he won that trade. Another member, this is just an invite. Is this the same guy? Yeah, this is the same guy. And then, so you can see like they're throwing around trades, they're engaging with each other, everyone's helping each other out. Awesome. We just launched this, and it's already catching fire. We got people chatting in this thing all day already. So awesome stuff. You're going to have access to that, right? That right there, you can go and find memberships to trader communities like that by themselves are going to run you $199 a month. And some of you guys maybe already are part of some of those where you're paying a couple $100 for a chat group like that, a community like that, where people are just sharing this information, right? So awesome value there. And then you're going to get 2 one-on-one sessions, beginner sessions with a professional day trader. And this is 99% savings on this one, guys, $10. $10. So go to daytradesmart.com/free and sign up for $10. And let's get you guys going. Let's see if this is a good fit, so that if it is, then we can talk to you about our Trader University that ranges anywhere from, for enrollment, anywhere from $2,500 all the way up to $23,000. And that just depends on where you're at. If you feel like you're more of a DIY type person, or if you need a little more hand-holding or a lot more hand-holding, whatever it might be. But those are conversations that we can have once we've had an opportunity to show you what it is, let you try it out, take it for a test drive, and then after that decide, are you a good fit for us? Are we a good fit for you? And then we can talk about our Trader University, the full day trading university. All right, guys, that wraps it up for us today. I appreciate you guys joining us for another session of the sweep. If you have questions, of course, feel free to reach out to us, info@daytradesmart.com, or on any of our social media platforms, and we'll look forward to talking with you guys next Friday. Have a good day and happy trading.